You have a Windows view on exactly what's going on in the economy. How are we doing?
Well, so I'll talk U.S. more because you've got all these people interviewing about the world. But in the U.S., our research team, which is the best in the business, has a mild recession predicted sort of mid this year into next year. They push that out. And so why they keep pushing it out, it's the strength of the U.S. consumer. They have the Fed getting over 5%, 5.25%. Just this week, they moved that to 3 25 basis point rate rise as opposed to 50, meaning, again, the Fed can slow down a little bit because you're seeing inflation go over. And so that's what we have. And so this year ends up being positive. Next year ends up being positive, but you have a little trough in the middle. And that really is reflective of what you saw this morning. Employment's still strong. People are working. They're getting paid more, but they've got to get to inflation, so they have to keep the rate structure up here for a fair amount of time until they get the services side inflation down. And the market may be misreading how fast that will take. But on the other hand, we're a heck of a lot better shape than all these other economies I talked to out here.
That's for sure. So pushed out the possible recession, your research team did. Is it also looking shallower because the economy is more resilient than we thought it was?
Well, the consumer is very resilient, and look, new claims for unemployment were down in 190,000 before the 2007-8 recession, Great Recession, financial crisis. They ran 330,000 each posting. So think about that difference. In the workforce, about 20% bigger. These are down to numbers consistent where they were in 50 years ago when the workforce was half as big. So the employment's still strong. Now, are we all being more careful about hiring? Are we all trimming our head count by attrition? Are we all flattening out? And some industries are actually taking head count down. So that may change, but it hasn't changed yet. The money in their accounts is still there. And it's come down a little bit. They're starting to spend it. But on the other hand, it's multiples of where it was pre-pandemic. They have lots of borrowing capacity. Now, what's quickly stopping? Obviously, mortgages got expensive and house purchases stopped, but the dollar value of housing that shot up after the recovery, yes, it's come down, but still way above where it was in 19. And so people have to think about this in the perspective of long-term growth rates that fell and then shot up with all the stimulus and now are settling in. And the Fed has to bring inflation down because inflation will eat away at purchasing power, and that's really not good for especially median-income households.